Hi, my name's David Alemian, host of the It's About Money radio show. I've been a life insurance agent for over 16 years. I'm also a life insurance trainer and a life insurance recruiter. Today, the question is, what is indexed life insurance? Well, what it's really called is equity indexed universal life insurance. You see, indexed life insurance is a type of life insurance policy, and it has to do with the crediting strategy for the life insurance policy. Here's what I mean by that. Universal life is also permanent life insurance or cash value life insurance. It's the type of life insurance that builds a cash value. It has a premium, it has a cash value that grows, and it has a death benefit. Now, other types of life insurance, like for example whole life, the interest crediting strategy, in other words, how much interest is credited each year to that cash value, is based on a declaration by the company on an annual basis. And it's based on how the company does in its own investments. Indexed universal life, or equity indexed universal life, is tied to the stock market. Say the S&P 500, one of the indexes, or the NASDAQ, or the Nikkei, or the Dow. It can be tied to as many as 5 of them. It can even have a guaranteed interest rate of, say, maybe 3.5% or whatever it may be. You can take that money and you can split it up between several of them. It depends on the policies. And I don't wish to confuse you by getting too detailed here. That being said, the most popular index crediting strategy is the S&P. And what it does is it's tied to the S&P, but it's not in the S&P. And what that means, quite simply, is you can take advantage of market swings going up, but have none of the downside risk. What I mean by that is if the market goes up, interest is credited to your account. If the market goes down, depending on the company and the policy, you might get 1 or 2% interest anyway, or at the very worst, just remain flat for that year. It's amazing the power of zero, meaning zero losses. And that's what equity indexed universal life is. Now the question is how do they do that? How are you tied to the market and take advantages of market upswings and have none of the downside risk? Because it sounds too good to be true. Simply put, you're tied to the market but not in the market. And here's what the insurance company does. In general terms and generally speaking, they can guarantee you, say, a few percent interest, say 3.5% interest. Instead, they take that 3.5%, and they use it to buy options on the S&P 500. If the S&P goes up, they exercise those options and interest is credited to your account. If the market goes down, they simply don't exercise those options and you don't lose anything. The only thing that you gave up was maybe that guaranteed of that 3 or 3.5%. That's all it is. But you never lose money. And the interest is always locked in. They have what's called an annual reset, so that any gains become part of the principal, and that is locked in there. They're also similar to equity indexed annuities. But that's for another day. My name's David Alemian. Thank you for watching.